Hello. I hope all of you can hear me clear and loud. Can you please confirm in the questions panel? Hello. I hope all of you can hear me. Yes, thanks. Thanks for the confirmation, John. Thanks, Vikas, Kunal, Kaustubh, Muskan. Thank you so much, everyone, for all of these confirmations. And welcome again to another QuantInsti webinar. And today we are going to talk about how to create a trading algorithm from scratch. But before we begin, I would like to, for those of you who are new to QuantInsti, a quick introduction. So we are an algorithmic and quantitative trading research institute with a registered user base in more than 200 countries and territories across the globe. And QuantInsti's flagship course, Executive Program in Algorithmic Trading, EPAT, is world's first verified algorithmic trading certification. It is developed for professionals who are looking to grow their career or business in the financial markets. So just to give you an idea, upon joining EPAT, you get an access to most comprehensive quant trading curriculum that is out there in the industry, and you also get an opportunity to learn from the world-class faculty pool, including industry stalwarts like Dr. Ernest Chan, Dr. Ivan Sinclair, Dr. Thomas Stark, just to name a few. You can also complete a specialization in desired asset classes and in various trading strategy paradigms through live project and mentorship. And the most important part about EPAT, you will enjoy a personalized learning experience with best-in-class support, which is topped by lifetime career assistance and course access. So, in a nutshell, if I want to, talk about EPAT, it's not just a course or certification. It's actually much more than that. It's an experience, right? And for those of you who are serious about growing professionally in the financial markets with the help of all these quantitative methods and advanced technology, EPAT can be a game changer for you. So to know more about EPAT and how it can help you, you can simply schedule a free counseling call today with our course counselors. So I have just shared a link with all of you over chat, and they just go over there, book a convenient time slot, and some of the experts from our side will help you understand how EPAT can help you in terms of going professionally in the financial markets using all the quantitative methods and cutting edge technology that is out there in the market. All right, so that's about EPAT and QuantInsti. Moving ahead, as I said, today's topic we have how to create a trading algorithm from scratch. So this is a basic webinar that will be presented today. And for today's presentation, we have here with us Ashutosh. Now, Ashutosh has recently conducted a session in our 3-day algo trading workshop. And if you go on our YouTube channel, you'll see that there are tons of questions and so much interest over there. So that is why we decided to do this session as well. So today, Ashutosh is here with us. And about Ashutosh, so Ashutosh has more than a decade of experience in the area of financial derivatives trading and quant finance. Apart from contributing to overall content development at QuantInsti, he also teaches Python in our flagship offering, as I already mentioned, EPAT, right? And he has worked as a derivative trader specializing in trading interest rates and commodities with a proprietary trading firm in London for several years before joining joining QuantInsti. And his key areas of interest include applying advanced data science and machine learning techniques to financial data. Academically, Ashutosh holds a master's in statistics with distinction from London School of Economics and a certificate. He is a certified FRM, and he's also a co-author of a book which is an amazing book that is called A Rough and Ready Guide to Algorithmic Trading. So yeah, so I think without a further ado, I would like to welcome Ashutosh. So Ashutosh, are you here with us? Hello.
Yes. Hi, Kshitij. Thank you so much for the generous introduction.
Okay, so I have just shared presenter rights with you. You can share your screen now.
Okay, yeah. Just give me a moment, guys.
Sure, Ashutosh. So I think for the audience, I think recent sessions that were done by Ashutosh, like a lot of public sessions we've done together, and we've seen a lot of interest on them. And I think a lot of that data and insight is going to be covered in this webinar as well. Yeah. So Ashutosh, I'm going to mute myself now, I think, and
Okay.
the stage is yours now. Thank you.
Okay. Thank you so much, Kshitij. Uh, so I hope all of you are able to see my screen. Hopefully. Okay, great, great. Thank you for the confirmation. Um, so guys, welcome to this webinar on how to create a trading algorithm from scratch, right? So this is going to be, yet another value adding session from QuantInsti. Uh, and hopefully you will, learn a few things that you didn't know before, and, you will be able to apply them in your day-to-day trading, right? So let's begin. Um, all right. So first of all, we'll start with a customary disclaimer. So all the trading strategies and whatever we discuss in this webinar uh, involves risk if you implement it in the market. So any decision to place trades, including trading, is a personal decision, right? Um, the trading strategies or related information mentioned in this webinar is for informational purposes only. Okay, so that was our customary disclaimer. Just quickly, who we are. So now all of you know, Kshitij gave a very nice intro. So our parent company is iRage Broking, which is one of the largest high frequency trading companies in India. And QuantInsti is the company that I represent. We have got three products, basically three verticals. So EPAT, you guys already know about. Quandra is the self-paced course portal, which is another popular offering, and Blue Shift is our cutting-edge platform for research as well as for automating your trading, right? Um, all right, so Kshitij has already talked about me, so I'll probably just give you a brief intro that I have like a decade of experience in derivatives trading, and yeah, so I'm also a co-author of a book called A Rough and Ready Guide to Algorithmic Trading. Okay, so let's come to the objectives, right? So what are we going to learn today? Uh, First of all, we'll see why we need to learn about trading algorithms. Then we will move on to see what trading algorithms are, right? Then we will break it down, right? So the whole idea about this session is to learn the nuances, right? How you basically break down a complex thing into smaller chunks and see how they fit in with each other, right? Then we will see how we can convert ideas into strategies and strategies into trading algorithms, right? So that will be done with a few examples. So we'll also take example of a momentum strategy and a mean reversion strategy, right? Then we will have a small discussion on back testing and forward testing and things we need to take care of, right? Okay, so first things first, why do we actually need to learn about trading algorithms, right? So here's a slide that you would have seen a few times, but it is very important for us to emphasize the fact that the world is moving towards automation, right? So as you can see, these are basically the market share of different kinds of participants in the US market. So basically, you can see that retail investors are just a minority, and a large chunk, right? Almost 60-70% of the trading is being conducted um, in either automated fashion or via quants, right? So just to emphasize the fact, uh, So markets are increasingly being dominated by algos. Industry has moved towards automation and use of data-driven approaches, right? So what is data-driven approach? Like what quants do, right? They also derive trading rules from the data itself, right? So there are two ways you can do it. Either you have some experience in the market, in which case you will have some idea and some hypothesis that you want to test, right? Or you can just take data and study the patterns in the data to derive a trading strategy out of it, right? So that is why it is important to understand the ways and techniques of the majority of the market participants, because ultimately we are operating in the same pool, right? So it is important to understand, and that is why many retail traders are also adopting these methods. That is why we see a lot of interest even from the retail side to learn all these cutting edge tools and technologies to derive trading strategies as well as automate their trades, right? Okay, so we pretty much know like the advantages and benefits of using algos. First of all, of course, a trading minus emotions. So if you are using a trading algorithm, then you can let it work, in peace, and basically you will not take unnecessary discretionary steps, or you will not intervene, and it will also, keep you away from emotions of greed and fear, because all the trading actions will be taken care of in an automatic fashion, right? In a systematic way. Secondly, uh, of course, human errors and physical limitations. So these days, for example, crypto markets are open 24/7, right? So machines can actually work 24 hours, whereas human traders will get tired, and they will need their rest, and all the other human needs and limitations come into play. uh, you can also scan many more markets for different kinds of opportunities, right? So if you really want to scale up, then machines are the way to go, right? And finally, you can grab those opportunities with speed. So basically, by the time you go to get a cup of coffee, a very short term opportunity has come and gone by, right? So whereas if there's a machine which is deployed, then you can easily make use of those opportunities. Okay. So that is the those are the advantages of using trading algorithms. Okay, so let's come to the meat of the presentation. So what is a trading algorithm, right? So this is the question. So let's deal with it at a very intuitive level. We'll try to understand what it is in a very simple way. So first of all, of course, it's a computer program, right? It's an algorithm. So of course, it's a computer program. That does what? That does three things, right? So first of all, it analyzes the incoming information or data. Okay. Secondly, it generates buy and sell orders based on preset rules. So of course, that program already has a set of preset rules. Okay. And it will generate buy or sell orders. And thirdly, what it will do is that it will interact with the outer world, which is of course your either your broker or your exchange, right? To send orders and to receive confirmations, right, etc. So in a nutshell, these are the three major tasks an algorithm has to take care of, right? Uh, but what is the fuel? What goes into these algorithms, right? So let's discuss that. What actually fuels these algorithms? It's the data, okay? And data is one of those things which which is the basically the foundation of algo trading and quant trading. So what kind of data can we utilize for a trading algorithm, right? So first of all, very at a very basic level, you have got the market data. So what kind of data is it? It's price, volume, open interest, delivery volume, etc., etc. Okay, so that is your market data. Secondly, you can also make use of technical indicators, so moving averages, RSI, Bollinger Bands, etc., etc. Right? But what are technical indicators? They are just a transformation on the market data. So you take price and volume, and you create another. You combine that information and you create another indicator, right? So for example, say VWAP or something is basically a combination of price and volume, right? So in that way, you can transform market data into more, understandable and usable form, and you call it technical indicator, right? Then you have got fundamental information, and fundamental information can be either company specific. So, for example, company specific information would include the P by E ratio of a particular company, or different kinds of profitability and risk ratios. How much debt the company has, debt to equity ratio, etc., etc. That would be company specific. And you can also have macro data, right? So macro data is what is affecting the larger economy. So you have got GDP releases, okay? You have got inflation data coming out, right? So in the US, people who trade US markets, they know non-farm payrolls, which is basically, the employment data that is released every Friday. For those who trade commodity and specifically oil. So every Wednesday there is IEA oil inventory data, right? So that is one of the big movers for the market. Okay. So that sort of data can also be fed into trading algorithms. And finally, at the very forefront of latest technology and utilization of data is basically what we call alternative data, right? So this could be news, Twitter sentiments, satellite imagery, etc., etc., right? Uh, because machines can read, numbers. So of course, all those sentiments or whatever news there is has to be converted into machine readable format, right? Either by using some machine learning models, etc., uh, so that you can basically make use of them in your trading algos. Okay. So that is what is the fuel. Okay, this goes into your trading algorithm, and this is the input, right? Okay, so let us discuss what are the components of a trading algorithm. Okay, um, again, so we divide the whole process into three parts. Okay, so the first part is before trading starts. Okay, so what things should we do before trading starts, right? Okay, so the first of them is to define the universe, right? And what is your trading universe? It is the set of assets that you are going to trade, right? Or you will consider generating signals on, right? Um, Now, defining your trading universe is, a task in itself, and a lot of thought and care needs to go into it, right? A lot of experience will go into it. So, for example, if I want to trade a particular, stock, for example, right? I want exposure to say a technology stock called Infosys, right? So I can either trade the stock, I can either trade the future, I could also trade the options on it, right? So even for the same asset, I have got different instruments which I can use, right? And all of these instruments have different risk profiles. Okay, so those of you who trade futures know that they are leveraged. Okay, so there is a special care that you need to take while trading futures, which is different from when you're trading in the cash market, right? So all those things you have to think through before you define your universe. Okay. Second is defining the alpha. So what is alpha? Alpha is nothing but the reason which will generate profits for us, right? It could be a spatial way of looking at the market variables, right? It could even be a simple technical indicators, or it could be your edge in the market, which will generate excess returns, right, over the market or a benchmark, right? And this also forms a very important part of your strategy, right? Uh, in fact, I would go as far as to say that this is the most, researched part of the strategy, right? So, for example, people are always, in pursuit of one holy grail strategy, right, on which they can generate signals and make money. Uh, and that is basically, where they are actually chasing alpha. right? Uh, then we go on to define trading rules, right? So alpha basically is a quantified form of information which you can use to define trading rules. So, for example, if your alpha factor is saying that now you should get in, you need to decide with how much size should you get in. Okay, what should be your take profit, or what should be your stop loss, or at what point in time should you stop trading, right? Is it going to be an intraday strategy, or is it going to be a positional strategy? Okay, so when you go on to decide trading rules, you have to take care of all these things, right? And also, even if you have an alpha factor, you need to optimize the parameters, right? So for example, if you're using RSI, you need to know what day RSI are you going to use. Is it going to be 14 day, 20 day, or 30 day, right? uh, so all those things will require a lot of research from your side. Okay, and finally you will have to initialize the strategy parameters. Okay, so initializing strategy parameters, okay, once you have done all your research and back testing, etc., then basically just before you are going to, fire up your trading algorithm, you need to initialize the parameters. You need to provide some values. Okay, so this is all done before the trading starts. Okay, next is during trading. Okay, so what happens during trading? Okay, this is where your trading algorithm will come into action, right? And all these things need to be done, right? So it needs to fetch the relevant data. It needs to compute alpha factors or indicators, right? Then it needs to take, buy and sell decisions after, based on the rules that were preset. And then it needs to send the orders to the exchange. Okay. And this thing we'll have to put on a repeat. Okay. Why? Because suppose you are running an intraday strategy. So every 5 minutes, it can fetch data, compute indicators, check if, according to your rules, it should be sending a buy or a sell or a canceling order to the market, and then actually send those orders, right? So all this basically needs to be scheduled at regular intervals, okay, depending on whatever trading frequency you have, right? So for example, if you have got a positional kind of strategy or an investment strategy, you can decide to repeat this every month or every week. If you have an intraday strategy, you can do this every 10 minutes, for example, right? Or 5 minutes. Okay. Uh, so this all happens during trading. And finally, post trading. Okay. Once it's the end of the trading day, right? What do, right? So you monitor the performance, you analyze the results, you see if everything, is as, you thought it would be correct. You conduct different kinds of analysis. You make sure that the reason for trade still exists, right? So on a regular basis, you should be checking if, if there is a regime change in the market, for example, right? So for example, you might have deployed a momentum strategy, but suddenly the market goes into a mean reverting phase, and it has been like that for a few days. Then you need to, either tweak your strategy or actually scrap it, right? So all those decisions become part of your regular R&D, right? So that's after the trading has stopped. Okay, so these were the three phases largely. Okay, now we will discuss a few examples. Okay, so that was the idea. Now we will see how we can convert ideas into trading algorithms. Okay, so here I have the spectrum of trading strategies. Okay, now so you can see that, there are different paradigms. So there's trending, momentum based strategies, mean reverting based strategies, breakout, carry. Okay, event based. So what is carry? Carry is basically where if everything else remains the same, you make money just by the passage of time, right? So basically, for example, if some of you who trade short volatility strategies, right? So if you sell a strangle in options, right, for example, and you are just waiting because you want to eat up that theta decay in the option prices, right? That would be an example of a carry strategy. Um, But largely the focus of a lot of traders is either on trending or mean reverting, right? Um, Trending, again, you can approach it from different schools of trading. So for example, say fundamental, for a fundamental trader, it could be factor based investing, right? So for example, you can have a factor model where one of the factors is momentum, right? For a technical trader, you could have different kinds of indicators. For example, moving average crossover, right? Continuation patterns, etc. And for quants, it could be momentum, either time series or cross sectional, right? So time series momentum is where an asset's price basically increases over time, and you choose the winners in terms of assets which have done well in the past. Cross sectional is at a point in time you compare a few assets and buy the ones which have performed the best. So it is more relative to other assets rather than time, right? But largely the two most popular ones are momentum and mean reversion. Okay. So what is momentum in a simple way? So the core idea is that past returns are persistent. So basically, you buy and sell if the asset has performed strongly or weakly in the past. Okay. So if a stock has gone up for say X amount of time, uh, then you can. So you basically assume that it is going to keep going up, right? So that's a way you can define momentum. Um, but how do you actually quantify and capture it? So again, there are several ways, right? The most basic type is where you check past returns over time. So for example, you can say, okay, if the stock has gone up or has given a minimum return of X% in the last 6 months, then I will consider it, to be in momentum, right? Similarly, you can use technical indicators like moving average, MACD, RSI, etc. All of them basically try to quantify the momentum. And finally, it's based on relative performance. So this is what we refer to when we spoke about cross-sectional momentum, right? So instead of across time, if you check at one point in time, which of the securities has done relatively better compared to others, and then you buy it, right? So there are different ways, but what could be the most simplest way of capturing momentum, right? So for that, there's an indicator actually which is called rate of change or ROC, right? And this is just an example of how you can quantify momentum, right? It's a technical indicator which measures the percentage change in price between current price and price X period ago. Okay, so what could be more simpler than just checking how a security has performed, in a certain period, okay, and trade based on that. Okay, so here is basically an idea, right, or a strategy which is very simple in its construction. So we plan to devise a long only investment strategy. So long only means we are only going long, we are not going short. uh, Universe is the top 10 Nifty 50 stocks by market capitalization. So Nifty 50 is the broad-based index in India, right? So top 10 is basically, of course, all of these will be large cap companies with which will have very good liquidity and much less volatility compared to mid caps and small caps, right? So we have defined a set of stocks as our universe, right? Uh, Rules. So rules could be as simple as buy a stock in the universe when its ROC is greater than 2 in the last 63 days, for example. By 63 days because say assuming one trading month has 21 trading days. So 63 is basically 3 months. So if a stock has given at least a 2% return in the last 3 months, then you can buy it, right? So that is the idea. Okay. Now, let's actually just see how we can convert it into a trading algorithm, right? Okay. So for that, what we are going to do, guys, is we are going to use Blue Shift. Okay. So I assume all of you are aware of Blue Shift, which is our research and trading platform. If you are not familiar, we'll send you a link. You can make a free account. Once you make a free account, basically what you can do is that you can start exploring it right away. So if I click this strategy tab, it leads me to all the folders where I have different kinds of strategies. I have a separate folder for this webinar, so I will go there. And I've got two examples, right? So we are discussing this one, so I'll just open it. And a lot of you will, be surprised to see this kind of, uh, design, which is basically our, way of coding strategies visually, okay, rather than using any Python code or anything. So assuming a lot of you are new to coding, etc., this could be a great way for you to start putting together your logics, right? So this basically is a visual coding sort of IDE where we can connect these logical blocks, right? These are all logical blocks, okay? So just like how you play puzzle, right? These are all logical blocks. If you have a trading idea, you can literally convert it into a strategy. Okay. And so we'll begin. So once basically when I start, so I would literally have this block. Okay. So let's just break it down and look at it at a more granular level. Okay. So I'll discuss each part. Okay. Uh, right from the very basic. Okay. So when you start, you will only be able to see this block. Okay. So what we need to do over here is, of course, this is part of before trading starts, right? So to this block, I need to define, using this block, I need to define a few things, right? What is going to be my data set?
Ashutosh, sorry to interrupt. Just a small request. Can
Yes,
you zoom in a bit? I think
yes,
we are
yes,
seeing it,
sure,
but
sure.
it's not that. Thank you.
Fine.
Yeah,
Okay,
it's
I hope
perfect.
all of you are able to see. Oh, thank you for that. Okay, so if you can see, it has a few empty places where we will, fit different kinds of logics at later. But before we begin, we need to choose the data set. Okay, as we are dealing with the Indian market, and we are using daily data. I'll choose NSE daily. Okay, we also have the option of NSE minute, or for US market, we have got NYSE daily, NYSE minute, and for Forex market, we have got FX minute. Okay. I'll just choose NSE daily. Okay. I can always set a limit for max orders per day. Okay. So for example, if I want to stop my algo from doing something that I don't want it to do, right? In case my logic or there's some other issue with the code, then I can always set a limit. So for example, say 50. Okay. So that's the max orders my algo will send to the exchange. Okay. Similarly, I can set max quantity. I'll just leave it empty for now. Set long only. Okay, so I'll set it to true because our strategy idea is that we are designing a long only strategy, right? Then I need to give a number for slippage. So what is slippage? So whenever we try to execute a trade at a specific price, it is not necessary that we, you know, uh, get it at that price. Okay, it's up to the market whether we get a fill or not. So it's not always we get a fill on the price of our choice, and hence there is some amount of what we call slippage, right? So that's a uh, money we can lose due to bad execution, for example. Okay. So we'll set it up as per whatever data we have according to our own trades and which exchange we trade in. So I just put, for example, 0.005, right? And then this is you can set your commission per share, right? So whatever, depending on the deal you have with your broker, etc., you can have a number over here, right? And then we go to the main logic for the algorithm. Okay. So first of all, again, define universe, right? So as our strategy was to basically trade the top 10 Nifty stocks, what I can do, I can always go over here, right? Define my universe. Okay. Then I can choose set universe. So this is a logical, connector, and I can always select this block which says select assets. Okay. So if I know the market capitalization, so I can always add stocks here. So for example, HDFC Bank, right, is a big constituent of Nifty, right? So I'll say HDFC, right? So I can add one, right? So I can just keep adding different stocks, okay, over here, and I can always connect it like this. So this is my universe, right? Uh, Now you can see that the first thing says step one, define your universe, which I have done over here. So I can bring all of this and I can attach it to this place, right? Now, over here, basically, because we have got 10 stocks and I don't remember exactly which all 10 stocks, uh, you know, form the highest market capitalization. So I did my research and I already have those stocks over here, correct? So it's a similar kind of block. So I can just press backspace to delete this one and I can attach my universe in this tab. Okay. So that was the phase where I defined the universe. Okay. Second is I have to define alpha. Okay. So we know that alpha for this strategy is the ROC. Okay. Which is a technical indicator. So I can go here. You see something called as define alpha. You click there and you go to alpha functions, right? And then in alpha functions, right, we have got this block which says select indicator. Okay. And what kind of indicator we want. So we have some pre-coded, technical indicators over here, right? And if I want ROC, so uh, I will have to search for ROC over here, right? So let us see where we can find APQ. Oh, yeah, there you go, rate of change. Okay, so the name is different, but the idea is same, right? So rate of change is my function. And I need to define a look back. So my look back was 63 days, right? I needed to look 63 days. So I'll say 63, I'll say submit. Okay. And of course, the frequency is daily because I'm dealing with daily data, right? So this is the ROC part. Okay. So now I have my indicator. Now, what I have to do is that I need to use a variable, right? So whatever value is calculated from it, it has to be put inside a variable. Okay. So I can always create new variables from here, right? But I can just press this and create a new variable with variable name. But here, what I'll just do is that I have already created a variable called ROC, right? And I've got two sorts of commands. So one is you can set any variable, okay, to any value. So what is a value? Value is basically, what we will calculate from this function, right? So that's my ROC, right? And this thing I can always put in my define alpha function, right? So that's my ROC, okay? Uh, So similar thing, what I had done earlier was this, right? So you can see it's absolutely the same thing that I created now. Okay, so I can actually delete one of them, right? Okay, so what's the next thing that I have to do? I have to define the trading rules. Okay, so what were the trading rules for the strategy? Now for trading rules, we have got something called as the logic block, right? So you go to logic, and like if you have coded before, you know that you have got those if else statements, right? So if a certain condition is met, you have to do something, right? uh, so we have got that sort of facility over here, right? So and we can also make use of this comparison. So if something is equal to something, less than or greater than, etc., right? So what we have over here is that I create something like this. Okay, I create something like this. Just pay attention to this part. So if I break it down, what it contains is basically two things. Okay. So from the logic, I have got if a condition is met, do something, else if, do something else, right? So what is my condition? So if you go back to our strategy, our condition was that when ROC exceeded 2, okay, right, then we actually bought the stock, correct? Uh, Else, if my ROC is less than 0.5, which means I have realized a return of less than 5.5% in last 3 months, I need to exit the stock and square off my position, right, in that stock. So if this condition is met, what should I be doing, right? So what was the third part of a trading algo? It was to send orders, right? So if this condition is met, I have to send a buy order. If this condition is met, I have to send an order to actually square off the position. So if I'm long, squaring off means getting flat or selling, right, in that stock. Okay. So this is my thing. So how do I actually, put orders over here? So I have got this block which is called define orders, right? So I can always, define different kinds of orders. So for example, I can take this, right? I can tell it whether it's going to be a market order or a limit order, right? What is going to be validity, limit price, etc. Right? But for this one, we make use of something special, which is called order by fraction, right? So I'll just take these two things. What is this? Order by portfolio fraction. Uh, so often in investment strategies, we like to deal with the percentage of portfolio, right? That we need to invest in a particular asset. Okay. So if my ROC is greater than or equal to 2 for a particular stock, what I need to do is that I need to buy 10%. I need to buy that up to 10% of my portfolio size, right? If my ROC is less than zero point 0.5 for that stock, then again, I need to make its share 0, which means I'm just selling. What if I hold any of it? I'll sell everything, right, in that stock. Okay. And this thing forms the core strategy logic. Okay. And so this order by, you can find in the actions panel, right? So order by, then you can tell, if you want it by fraction or by units, right? Method. So target means it targets a particular value. So if I say 0.1, it will target 10%, right? And then again, you can, give it some value over here, what value you want to target, right? So similar thing I have done here, and I, put it in this logical block. Okay. So what was the next thing? Okay. So this is basically, you know, these are my trading rules, sort of. But what do I need to do? I need to run this logic, right? I need to schedule it so that my algo keeps running it, in an automatic fashion, right? So for that, there is a separate section which is called scheduling. Okay. So I can always go there and I can select schedule action add, right? Now I have got, different options over here, right? So for example, if I say frequency, first is never, before trading starts, after trading hours, and start, etc. Right? The ones we most commonly use are basically uh, these ones, right? Where we schedule it by date and time. Okay. So what I do is that I want to schedule, okay, this logic. I want this logic to run. Okay. When do I want it to run? I want it to run basically at the start of the week. Okay, so I have got several choices here. When I go to schedule date, I've got several choices, right? So what I'll say over here is that I want to run it at the start of the week, right? And schedule time, I want it to start, uh, I want it to run, 30 minutes before the close, right? And I'll just wrap all this inside here. And this sort of becomes my trading rule, right? Trading. Yeah, so this is my trading rule. Okay, so there we go. So we have a full-fledged strategy over here. I will delete the portions that are not required. Okay, and then we can just test it out. So for that, we have got a panel over here. So I'll select data as NSE daily. maybe for start date, I don't know, let's say 2017 January, and end date is probably 1st of July of this month. And maybe I start with a capital of 100,000, right? And I run this strategy. Okay. So it might take a little time. It will just build the backtest. Okay. So there you go, right? So the blue one is the performance of this simple strategy, and the orange one is the performance of the benchmark. Okay. Uh, So what happens over here is that, of course, we are doing very well. So this was a coronavirus crash, right? It sort of avoided getting into position just before the crash, because of course the ROC would have been less than 0.5. Of course, these are unoptimized values, right? You can play with these values and see which one works well. But this is how we have built a strategy algo, right? Now, point over here is that this is a momentum based strategy. So you look at beta. Beta is basically, it represents a correlation with your market. So it's almost around zero point 0.4, right? Although the drawdown is pretty good, Sharp ratio is fine as well, but the beta is zero point 0.4. Now, often people need strategies which are uncorrelated with the market, right? And that is where the mean reverting strategies or statistical arb or pairs trading comes in, right? This was one kind of algo. Now we will quickly go over the another kind of strategy, right? Which is basically a mean reverting strategy, right? So the core idea of mean reversion is that assets price will tend to revert to its mean, right? And any significant deviation is a good opportunity to get in, right? So there are different assets which trade in a range. For example, you have got several FX pairs, okay, or you can create your synthetic spread using two instruments, okay, which is the core idea of pair trading, right? So where even though the two assets may not be mean reverting, their spread is mean reverting, okay, and a simple way to do that is, for example, if I've got two assets, asset A and B, right, then I can create a spread, right? Spread is basically the difference between the two assets such that this spread is mean reverting, okay? Uh, and what I need to do is to calculate a hedge ratio. So for example, if asset B is 2 times as volatile as asset A, my spread would be price of asset A minus 2 into price of asset B. Okay, just to account for the volatility in asset B, right? And then I calculate something which is called as z-score. So z-score is nothing but a more standardized version of this spread. So if you guys have seen a normal distribution, to convert it into standard normal, all you do is subtract the mean and divide by the standard deviation, right? So the value of z-score would pretty much be between plus minus 3, right? So I can generate trading signals based on z-score. So the same information is over here, where I've got asset A, asset B, and these are prices. Okay. What we focus on is the spread between the two, the difference. Okay. So the difference sort of remains constant until this happens, right? In which case the blue asset is little undervalued and asset A is little overvalued. So what we do is that we sell asset A and buy asset B at this point, and we wait for this to come back to its usual mean, right? Uh, these are the prices, these are the spreads. So at this point, you see the spread between the two has gone up, right? And z-score, we just sort of standardize this spread, and it will mostly be between say plus 3 and minus 3, but we'll define a particular range, right? So if it exceeds plus 2, that means we need to basically sell this spread. Okay, selling means selling asset A, which is overvalued, and buying asset B, which is undervalued, right? And when again this spread comes back to its mean, right, we will exit the position, right? So we can define simple rules around this strategy. Okay, so what we'll look at now is basically a simple pair trading strategy between two banking stocks in India, right? So the universe is a pair of leading banks, right? And the rules are pretty simple, okay? if the z score exceeds 2, right, you buy the spread, and if z score is less than -2, you sell, right, and you exit when the z score lies in this range, okay, plus minus zero point 0.5, right. How we actually operationalize it is basically over here. So I'll go back to blue shift now. uh, Okay, so the code again. So we'll again repeat the same sort of steps, right? We'll define universe, alpha, trading rules, etc. in a similar fashion, right? So our universe over here is basically two leading banking stocks. One is called ICICI Bank, another one is called Axis. I will define alpha. So basically, if you go to define alpha, right? So within alpha functions, you have got this tab where you can get, you can compute pair stats, okay, in which you have got z score and other things, right, related to pairs trading. So that's what we have done over here, and we save it in a variable called z score, right. Similarly, we calculate the relevant hedge ratio. Okay, this is basically behind the scene. It will run a regression and it will calculate hedge ratio according to the respective volatilities, and this whole thing, right, would actually go into my alpha computation, right? Now I have to define the trading rules. So again, we can go to logic. We can get this, if elif kind of structure, right? And within it, I can put my order sending logic, right? So whenever z score exceeds 2, right? What I do is that I'll send an order for Axis Bank, right? And I'll send an order for ICICI Bank, right? So uh, if it exceeds 2, we are going to sell the spread, which means we are sending an order of size minus weights. Okay, so weight is a variable I've set to 1. Okay, so this is the order I have to send for Axis. And for ICICI, I have to make use of the hedge ratio, right? So weights multiplied by hedge ratio. So for example, like you saw here, it was 2 times the price of asset B. Okay, so 2 was the hedge ratio, right, to create the spread. Uh, so here I have created a spread, and in case my z score is less than or equal to -2, in this case I have to buy the spread, right? So I'll just send the reverse order. Okay. So instead of minus weights, I send an order for weights, which is 1, and for the other one also I send a minus order, right? So if the spread has gone 2 up, we are selling the spread. If the spread has gone 2 down, we are buying the spread. Okay. Then thirdly, this is an exit logic. So if the z score comes between zero point 0.5 and minus zero point 0.5, we will square off all the positions. Okay. So this is the action that we plan to take. Now I can always put it inside this scheduling logic. Okay. Uh, okay. And I am scheduling this strategy for every day, right? So every day it will run this logic 30 minutes before market close, right? So here I have, option. So I'm choosing market close and I'm offsetting it by 30 minutes. Okay, so just 30 minutes before the market close, it will run this logic every single day, right? And this goes as my trading rule. Okay. Now, once I have this, so this might be a little complicated for those of you who are seeing pair trading for the first time, but I assume a lot of you have already done it or you're doing it, right? So it remains one of the more popular strategies. Uh, Again, so for running the back test, so for example, let's check. All right, let's say 2017 to let's check 18, 19, let's say 20 May, and it will take 100,000 right? End date. Okay. And then we can, try to build up backtest like we did for the previous strategy, right? Uh, so it will build a backtest, right? So see, the core idea of this presentation was how you can build, these algorithms. Uh, it's not the profitability part, right? Because these are still yet to be optimized. But why would someone want to trade a strategy like this? Okay, and the answer lies in this beta. Okay, you see, it has got a negative correlation with the market. So any sort of momentum strategy will have a very positive correlation with the market. Okay, larger market. And if you really want to diversify your asset portfolio, sorry, your strategy portfolio, then people start looking at something like this, right? Mean reversion. Okay. So finally, you see, it has like done almost fine. But core point of why I shared this strategy is the beta, right? So this is what a lot of asset managers will also value, because strategies which are negatively correlated with market provides a very good diversification to the overall book, right? So yes, so that was all that I wanted to share from strategy perspective, right? Uh, Finally, what I want to discuss is that, of course, all of this required, a lot of understanding of different kind of statistical concepts and finance concepts, and knowledge of markets, etc. Uh, so a lot of you asked, like, how do I get there, right? So here are three, pillars of quant trading. So one needs to be acquainted with maths and stat, programming, and financial markets, right? And QuantInsti is always there to help you out if you need, help in acquiring these skills, or you want to, take quant trading professionally. Then we have got some amazing resources for you guys. Uh, but what we saw in today's presentation was that, unlike the perception, algo trading does not have to be complicated, right? Some of the most successful strategies have very simple ideas behind them, right? And there is literally no shortcut. So you need to put all the efforts to acquire these skills. And for that, we have got, an amazing array of resources, including several books, Quantra, which has got some amazing free courses as well as paid content. Blue Shift, of course, you can make a free account and you can, conduct different kinds of research and back testing for it for free. And then we have got our amazing blogs portal, which has got thousands of blogs, to enrich your overall learning experience, right? So with that, I conclude this presentation and I will be happy to take a few questions. Uh,
Wow, great presentation, like amazing. So, thanks, Ashutosh, for showcasing how to create a trading algorithm in the simplest manner. I know that this is not even the tip of the iceberg, and there are, way too much things one can do using technology and the quantitative methods in trading. So I hope it was a good learning experience, and we'll now pick up some of the questions. But before we pick up, we start off with Q&A. Just wanted to highlight. So any of you who are serious about improving your trading with the help of algorithms and these quantitative methods, or who really want to, save time and make sure that you learn algorithmic trading in a much structured manner from experts. So as I already mentioned, you can join a free counseling call and know how EPAT can help you. So I am again sharing the same link, and you can just simply book a slot there and connect with an expert to understand how algorithmic trading can help you individually, whether it is getting a job or developing a career or skilling in your current role, or improving your trading in general. So there are a lot of benefits which are basically, as I said, it's an experience. So you can just connect for a free counseling call on this link that I've just shared. All right, so now going ahead, we are going to start off with the Q&A session, and I'm seeing a lot of questions on GoToWebinar, and for those of you who are attending on YouTube, please pour in your questions. We do not have actually a lot of time, so we'll take 5 more minutes and try to answer as many questions as possible. And just to give you all an understanding about whether this session is going to be recorded or not. Yes, it is going to be recorded. The presentation, it will be shared with all of the registrants over email in next 24 hours, and you can anytime go to our YouTube channel and access this presentation, this entire webinar that was wonderfully delivered by Ashutosh. So I think there are already a few questions on GoToWebinar. So Ashutosh, do you have any preference? You would like to pick any of those?
Sure, sure. So yeah, so a very interesting question is from Krishna, who says, how does satellite image data have a correlation with trading? So Krishna, so for example, you know, uh, commodity traders, right? So for example, oil traders need to understand the demand and supply of oil, for example, right? And there are these different big inventory places, where you can monitor, right, the number of trucks that are standing, the number of ships, that are bringing crude oil to the port, etc. You know, so all that alternative data can be converted into machine readable code, and that is being exploited by different organizations and trading desks, right? Similarly, you can, so for example, NASA has a program called Night Lights, where you can see the lights in the night in a particular geographical area, and you can determine the level of economic activity there, right? So all those things are possible with technology. Nothing is off the limits. All right. So how many trade order per second allowed in Indian market, right? So it depends, right? The limit of how many orders you can send depends on what kind of so for example, lease line you take, right, with for sending orders, right? So I'm not aware exactly of what is the limit here, but it largely depends on what kind of trading you are doing, right? So for example, someone who's doing HFT would require to send thousands of orders maybe, right, in a minute. So depending on that, there are different provisions by the exchange. So next question is by Muthu Kumar again, who says momentum strategy is applicable for intraday. Yes, it is. Um, okay, Satya says, what happens in a sidewards momentum? Will ROC for all the stocks be same? So sidewards would not be a momentum. I would say it would be more like a range bound, sort of environment where you would deploy mostly, say, a mean reverting sort of strategy. Uh, okay, so Trey asks, can the software work in multiple time frames between indicators? So yeah, that's a great question. I think it can, because what we can do is that we can schedule, different indicators with different frequencies, right? And that would definitely work. Uh, all right. So okay, so Nitai asks, what is the maximum number of alpha values we can define? We took only ROC. Yes, you can combine actually multiple alpha factors. So there is, going back, you can actually, nothing actually stops us from, defining multiple, alpha factors. So if you go over here, you can always go to define alpha function, right? And you can pretty much keep adding, stuff over here, right? You can define a variable and you can attach a new alpha factor, right? For example. Uh, yes, so Vivin, I think that answers your question as well, that you have to define different variables. Uh,
Ashutosh, I think, yeah. So there are a few questions on YouTube as well. So
okay, okay.
I would like to, ask you out. So these questions. So here, Neeraj on YouTube asks, is it possible for individuals to trade with algo trading on their own with their own money? Does it cost some fixed or periodic fees for the individual?
So yeah, it is definitely possible. In fact, a lot of retail traders at individual level do trade algorithmically. And nowadays, there are different brokers and different REST APIs available, which make it really easy for individual and retail traders to, trade in that fashion.
Thank you, Ashutosh. I hope, Neeraj, that answers your question. Um, um, Senthil is asking what is the cost of the course and any discounts. So, Senthil, you can connect with any of the course counselors on the list that I've shared, on the link that I've shared, and they'll be able to help you out with more details over there. Uh, Another question that we can see on YouTube is by Shirish. He asked, "Can we backtest custom strategy in Blue Shift?"
Yes, indeed, indeed. So, see, visual editor is one way where we have made it really easy for people to come, and if they have a simple idea, they can actually test their hypothesis right here, right? But actually, what you can also do is that you can go to this place which is called strategies. You can say create a strategy, right? You can say give it a name. I will give it name Ash1, and I have a choice, right? So for example, if I am looking at say a relative strength 4x strategy, I can choose to do it by code, right? So if I have got a more sophisticated strategy, right, I will probably go via the code route, right? So I can always code my own rules if I know Python, right? It makes it a great place to just code your strategy, using Python, and then you can again backtest it, and you can even paper trade it right here, and you can also go live if you have account with say a few specific brokers as of now. But yeah, so Blue Shift is really powerful. It allows you to, go as far as you want to go.
Thanks, Afrosh. So I think we are running out of time. So last two questions that we are going to pick, one from YouTube and one from GoToWebinar. So the one from YouTube, I think a very interesting question by Soumyashri Sen Gupta. She asks, does Blue Shift allow you to integrate with Zerodha? So Ashutosh, you want to pick that one?
So at present, no, I can, it can definitely, interact with Master Trust, which is another broker in India, but we are in the process of, just making it even more awesome. So who knows? Yeah, that might be, definitely possible in a near
Yes.
future.
So yeah, so we are right now supporting interactive brokers and also master trust, and we are also onboarding more and more popular brokers, not just in India, across the globe. So soon, we can definitely see something interesting coming up. Last questions we are going to pick, and that's with you, Ashutosh. You can select any of the questions from GoToWebinar.
Okay. All right. So let me just see. So yeah, so the question is if I want to short when ROC is less than 0.5, yeah, definitely. So basically, see any strategy. So this is basically, you can just change it to, whatever number you like, basically, right? This was a logical thing to do, 2%. But if you like, you can make it 2.5. You can try with 3, and you can still build your backtest, right? And this is what is basically called the equity curve. So it shows if I invested 100,000 rupees, okay, in the market. So market is my index, right, which is the orange one, and the blue one is my strategy. So my 100,000 would become two, you know, 2,10,000. So 210,000, right? For if I invested in this strategy, whereas it would become say 190, roughly 190,000 if I invested in the market, right? Plus, keep in mind that we avoided the big drawdown during the COVID crash, right? So people would have gotten heart attacks if their portfolio tanked by 30%, say in a week or so. But this sort of strategy was successfully able to navigate that phase, right? And this was only a very easy strategy. So here you can literally try and test different combinations, right? You can use multiple alpha factors, and if you have any idea that you already have, please go ahead and create a free account in Blueshift and make use of the data that is being provided to you, right? So we have got minute level data for US and Indian markets, and we have got daily data as well, right? and we also have got FX data. So yeah, please go ahead and do it.
Thanks so much, Ashutosh, for answering all of these questions. For those of you whose answers are whose questions are not answered, please be rest assured you will get a survey, okay, right after this webinar, and you can ask all the questions which are not answered there, and also share your feedback and the topics that you want to attend in future in these webinars, and we'll try to accommodate those topics, and we'll make sure that any of the questions that you have asked, they are not going to get unanswered, and we'll make sure that all the questions that we are going to get are answered. So I think with that said, thank you so much, Ashutosh, for such a wonderful presentation, and the entire audience from across the globe. A lot of you are in US, Australia, I think India, Singapore, and Europe. So amazing to see you all here, and uh, that's about it. So thanks for joining us today, and I'll catch you in the next one. So thank you. Have a great day ahead. Bye bye.